I'm Marilla Fernandez. Thanks for joining us here on Market Call. We have Mike Vinokur on the show today, portfolio manager at MV Wealth Partners with IA Private Wealth, taking your questions today on North American large caps. All right, here's how to reach us. 1-855-326-6266 if you want to phone in. You can also reach us by email at marketcall@bnnbloomberg.ca. Mike, thanks for coming in today. Appreciate you making it in. Let's talk about what has been a losing week for the TSX, down about 100 points, I think, at this hour. A lot of volatility, a lot of reaction to tariff, trade war. What do you make of what's going on just this week?
Well, I think this is the realization by investors that markets don't always go one way. There is generally a correction at some point in time. We're probably living through one. And, you know, we were expecting back in Q4 that there was going to be some kind of a softening in the economy in Canada, a slowdown in the US. We weren't sure if we were heading for a recession. But now with all the tariff talks and all the uncertainty that that's created for business leaders to really not know, should they invest, should they not, should they hire, should they not, what does the cash flow to them look like based on trade barriers, based on volatility in currency markets. This is going to potentially accelerate the slowdown, if not recession in the economy. And I think market participants are reacting to that.
I'm wondering whether you think investors will eventually sort of get numb to the rhetoric and maybe sort of settle in. Because right now, with the reality setting in this week, you can tell people just don't really know what to do.
Yeah, so this is a normal course reaction. You know, people always say that markets go up like escalators and down like elevators. The fear of losing is usually more acute than the euphoria from winning.
Sure.
And so, you know, it always looks bad. But we have to remember that the sun will rise tomorrow, and tomorrow is a new day. At this point in time, I think that markets will level off. You could probably say that markets are a little bit oversold. Are we overdue for a bounce potentially? Is this the end of the correction? I don't know for sure. But I think you are seeing more of a sell-off in the sectors that were, let's just say, a little bit more overvalued in our view. And you are seeing a little bit of nibbling in the sectors that just didn't get a lot of love from investors for quite a while. Okay,
so that being said, there are people who want to sit on the sidelines for a while. There are those who want to take advantage of this volatility. How do you advise those who do want to take advantage?
Well, first of all, if you have a long-term view, you need to know where you want to pick your spots. Right? You don't just necessarily want to buy into, because you need to know what you're buying into, number one. Number two, what's your objective? Is your objective to maximize growth? Is your objective to earn a decent income? Is your objective to protect capital, stay ahead of inflation, right? So if an investor knows what buckets they've got to play with, what is their time horizon, then they can start with portfolio architecture and designing a portfolio that's going to make sense for them.
Is this something that you take advantage of, the volatility? And if so, how do you do that?
Absolutely. So we came into yesterday with 30% cash. Yesterday I was buying a little bit, but I'm still sitting on approximately 28 to 30% cash in equity model accounts, precisely because we don't feel like we always have to be invested. We're tactical. We're value managers. If we don't see a margin of safety, we're not going to just buy in for the sake of buying in, even if a client says, I want to be involved in equities, because in our viewpoint, preservation of capital is first and foremost. But now that we're having a correction, now we've started to see some bargains. We had some price points that got hit yesterday. We've been buying. We will probably continue buying into next week into our favorite names, should they hit our targets.
Okay, let's go to a quick break. Mike Vinokur is joining us, portfolio manager at MV Wealth Partners with IA Private Wealth, taking your questions today on large caps. We're going to be back in a moment. And welcome back to Market Call. Thanks for joining us on this Friday. Mike is in house to take your questions. We're going to take an email first from Stu. Stu's question says, may I have Mike's opinion on BlackRock? All right, Mike, BlackRock.
Sure. Listen, BlackRock is a great name, great execution. Larry Fink, I think, has done a wonderful job in stewarding the organization. But this is just a name that for us has always been a little bit on the expensive side. There's nothing wrong with the company itself, but as a value manager, this just doesn't tick all of our boxes in order to take the risk and take a position.
Got it. All right, let's go straight to the phones then. We have Rob on the line. He's calling today from Calgary. Hi, Rob. What's your question today for Mike?
Hi, thanks for taking my call. I'd be interested in hearing Mike's opinion on Pembina Pipelines. It's had a bit of a bump over the past few months, and I'm just wondering, does he see this as a trend that might continue, or is this a good time to buy, or do I wait and see if it goes on sale? Thanks again, and have a good weekend.
We get quite a few questions on Pembina.
Well, thanks, Rob, for the question. I think Pembina has been a great operator over time. It certainly has a nice dividend yield. I think all of the pipelines, Enbridge and some of the others, have had a bit of a rough patch, A, because, markets are correcting in general, but B, there's this whole, I guess, cloud over the tariff thing and how is that going to potentially impact pipelines or not. I don't think the tariffs really impact the pipelines because they're a toll road. They have nothing to do with the actual ownership of the product. The product shipper, i.e. the oil and gas companies, are the ones that ship, let's say, to the U.S. So they're the ones that are, going to be subjected to a tariff if there is any, or the buyers, I guess, on the other end in the U.S. Will have to pay the tariff. I think that with interest rates in Canada going down lower and generally speaking demand going up over time, Pembina should be okay. Whether now is the time to buy it, I'm not sure. You may want to look for a bit more of a correction there just because of the way the chart's been acting. But if you're a very long-term investor, I'd say sit tight, collect the dividend, and I think you'll be okay over the long term.
Got it. Energy might be in fluctuation for a bit because, as you mentioned, the tariff situation, not only at that national level, but the Ontario Premier wants to weigh in on this too, and he wants to add his own tariff to the U.S.
Right, but I think that's on the electricity side. Yeah. I don't think that has anything to do with oil and gas per se, but you're right, energy in general.
Okay, let's go to Omar's on the line from Ajax, Ontario. Hi, Omar.
Hi, thank you for taking my call. My question is about Visa. I just want to know if you hold that company in your guys' portfolio and if you could recommend a good time or a good price point to get into the stock. I'll hang up and...
Okay, let's take a look at, we'll pull up a Visa chart in a moment.
Sure.
There we go. Visa up 21% over a year, so 339. So it's pricey to get into.
Yeah, thanks for the question, Omar. We don't own Visa. I wish I'd bought it many years ago. Sure. It's obviously a really good performer, but again, it's one of those companies that always attracts a very high premium multiple because I think it's seen as this, oligopoly in the payment space, and it really is. I mean, there's Visa, Discover, and Amex and MasterCard, right? So it's the four horsemen in that space. But again, for us, I'm concerned right now that if there is a downtick in the economy, prices paid for things could potentially come down, which if you think about the toll road, Visa is a toll road, right? So on every single dollar of transactions, they make a small percentage. So if the value of goods goes down or if the amount of transactions goes down because people pare back on their spending, the toll road is going to have less traffic on it, which means potentially there's going to be lowered earnings. So I don't own this name. If it ever got cheap enough for our value bucket, I would definitely consider it because it's a franchise quality name. The brand is fantastic. The business is great at very high returns on capital, but just very expensive.
On the flip side of that, if we do go into a recession or people are having a harder time, do they tend to charge more, in which case Visa could win from that?
Do they tend to charge more? Well, generally speaking, from our perspective, if we do go into a recession, people stop spending or they are very cautious on what they spend.
Okay, so it would actually be a drop. They will still spend, but but overall less.
Yeah,
Got it.
absolutely.
Okay. Let's go back to the phone line. Sal is on the line. He's calling from Toronto. Hi, Sal.
Oh, hi. Yeah, my question's on the alternative lender, Goeasy. The recent earnings report seemed pretty positive. I think what the overhang currently is the CEO, but that's been we've got an announcement on that, and then the other things about tariffs, and maybe there's a general uneasiness about the Canadian economy for that. But I was wondering if you think Goeasy is a good attractive price point right now to enter, or if not, then what you think would be a good value to get into this name. Thanks.
A lot of interest in Goeasy.
Yeah, so I think the company is wonderful. I think they've proven themselves over the last number of years to be a fantastic operator and a very good risk manager. Having said that, if you look at the delinquencies on credit cards, if you look at the rise in bankruptcies, if you look at what is going on in the overall economy, we think that there's going to be more credit defaults. Well, I'm not sure about the percentage of their secured versus unsecured lending book, but I do know that Goeasy clients, generally speaking, are not prime clients. So if our view is that the economy is going to slow down and credit defaults are going to rise in general, one would think that it's going to hit Goeasy more than it will hit prime credit lenders. Having said that, I would say to you that if and when that happens, perhaps that could be the opportunity to enter the stock, because they will benefit on the other side of it when the economy does start to expand, and they will have the capital to reinvest and create new loans at what are truly accretive returns on capital.
Yeah, so a good time to wait a little bit at least and see how this goes.
Yeah, I mean, you never know, of course, and they're great operators. I know that there's been a change of the CEO recently. But yeah, it's more about a macroeconomic concern more than it is an operating concern at the entity level.
Got it. All right, we do have to take a break. Mike Vinokur is sticking around, portfolio manager at Propellus Wealth Partners with IA Private Wealth, and taking your questions. Here's how to reach us. We're back in a moment.
Making sense of business and the economy can be tough. We dig through the details to tell you what you need to know with straight talk and expert analysis so you can make informed decisions about your future.
Taking Stock, Fridays on BNN Bloomberg.
Welcome back. Thanks for joining us here on Market Call. We are going straight to your questions. The first one in an email from Ryan. Ryan says, I'd like your guest thoughts on CN Rail. Now, I'm in my 20s, good time to start, and looking to add some long-term. And with that in mind, what PE range would you be comfortable with adding more regularly out of each paycheck? So starting young, are the railways a good investment to keep over that longer period of time?
So CN and CP are oligopolies in Canada. So they will, generally speaking, always make money. I don't think that there's a risk of the business entity going out of business per se, and I don't think that AI technology or something like that will make railroads obsolete, at least anytime soon. But having said that, it's a very capital-intensive business, okay? And so not only do you have operating costs from maintaining the actual railroad, you've got unionized workers from the train conductors to the maintenance workers, the actual locomotives themselves and the capital equipment involved in running a railroad is quite intense. So the free cash flow of this business is not that amazing as a percentage of revenue.
Okay.
And I could be wrong, but I think that even with the pullback today, CN's still trading at somewhere in the 18 to 20 times earnings, PE earnings range. So not necessarily extremely expensive, but not that cheap if you're looking at the earnings yield to the shareholder. So if you have a very, very long-term view and you want something that's going to be reasonably stable, grow about as fast as the economy, maybe a little bit faster, maybe get some efficiencies along the way and collect a dividend, yeah, it's probably okay, but this is not something that we own.
Got it. Let's go to the phone line. Sam is on the line. He has a call today. Sam's calling from Toronto. Hi, Sam. Sam, are you there? Okay, I'm going to try one more time. Sam, are you there? because I felt like I heard his voice. Okay, so Sam's question was actually about Celestica.
Celestica, yeah. This name brings me back to my university days, if you believe it or not. So Celestica has been an on again, off again story for
decades.
So long, yeah. And we missed this one. I wish I got onto the bandwagon. What was it in July of last year, June of last year? What a ride!
Yeah.
But again,
82% over the year. Wow.
Yeah. But look at the fall, right? I think it hit what, 220, and now it's at $116.
Yeah.
So what, 50% in a couple months?
Yes.
That's quite a bit of volatility. Nothing wrong with Celestica itself. I think management is great. I think the way that they've executed is wonderful. I just think that they got caught up in this euphoria of AI and chips and contract manufacturing. And this sort of reminded me a little bit of the 1999-2000 internet craze. And so now you've got the AI craze. And I think now we've got the deflation of that craze and people realizing that, whoa, wait a minute. We don't know what the use cases are going to be. We don't know what the actual demand is going to be. We don't know what the profitability is going to be. Should we put the brakes on? And so I think this is indirectly being hit because the market is starting to worry that, whoa, that growth that we saw and what we were paying up for, do we really want to pay that kind of multiple expecting that kind of growth to continue to be, as far as the eye can see? I don't think so.
Why do you think we're seeing, as you say, the deflation of sentiment? And I'm wondering if it's because we haven't seen necessarily practical applications of AI for the everyday person.
So I think there's more and more practical AI applications coming at us every day. But I think that the market is starting to realize that we are able to do more with less. I mean, DeepSeek, sort of, if you believe what DeepSeek is able to do, that was sort of the first about face on, wow, how much do we really need to invest to get the output that we want to have? And, I'm always fascinated by the fact that before Google, Alphabet, Yahoo, Netscape, all of these things, you didn't even know Google. Two guys in a garage disrupted the whole industry. DeepSeek, with what, $6 million or some very low amount, potentially disrupted the industry, the nascent industry. So who's to say that the next DeepSeek doesn't come out and does even more with less? And what does that mean about the huge amount of investment required from Microsoft and all the hyperscalers?
Yeah. So it's a market check, basically, as opposed to people.
I think it's a market check. I think people need to reduce their euphoria a little bit and think pragmatically and calmly about the future and valuations.
Got it. Let's go back to the phone lines. Vahid is on the line calling us today from Victoria. Hi, Vahid.
Thank you for taking my call. I would like to get Mike's opinion about Marvell Technology. Is it a good time to get in or not, and what Mike think about that one? Thank you very much.
Thank you, Vahid. So full disclosure, we owned this one. We sold it a little bit too early, regretfully. It then went on to go up another 30% without us.
Did you sell it end of year kind of thing?
Just before the end of the year, so in the high 80s, if I'm not mistaken.
Okay.
And so we had a very nice profit in it, and I thought, wow, I'm going to get off this train. And of course, the train kept going without me.
Sometimes it does.
Sometimes it does. But again, we got rid of our chips exposure because I was starting to really get worried that valuations were really getting out of whack and that the sentiment was so high. And, a company like Marvell, they make fantastic products. So again, management, this is why we owned it in the first place. Management is first rate. The product is first rate. But if you look at what they're saying, especially in the last quarterly report, that, growth is slowing down year over year. Sales growth is slowing down. And if you look at next year's earnings estimates, I think, they're going to make $2 and change, maybe $3. So even at this price today, with the huge pullback that it's had, you're talking a 20+ multiple on PE. Now, if the growth numbers are correct, and there are some estimates out 4 or 5 years out that this company could earn $7 a share, and you believe in that number, then maybe today's price is a bargain and you need to close your eyes, buy a little bit, tuck it away, and wake up 3 to 5 years later, and wow, you should have potentially a good return. The problem is that in technology, things change so quickly that today's front-runner winner is potentially tomorrow's loser. Yeah. And I look at Intel. I mean, Intel was the go-to chip maker back in whenever, the 2000s, and now nobody talks about Intel.
Yes. Okay, so some good advice tucked in there. We have to take a quick break. When we come back, a look at our guests' past picks. That's coming up next. Welcome back to Market Call. Time now for past picks. Mike is in house to walk us through what happened with the stocks he picked from last year in July. State Street was the first one. State Street out of New York, recommended at 73.72 American, currently at 88.69 American, up 20% return, total with dividend 22% return. Tell us about State Street, essentially an asset manager.
Yeah, so they're an asset manager, they're a custodian, they provide some technology-related services, some admin services. So they, people think of them as a financial, but they're not really a financial. They're more a service provider and custodian to the financial services industry. But, they're still... they still have, lots of clientele. They operate around the world. They recently did a huge acquisition from Mizuho in Japan of some global custody assets. So really huge economies of scale now in this business. Very steady Eddie grower. Obviously, their fees will come down if markets come down, and then if markets rebound, their fees rebound. So they do have that market sensitivity. But essentially, we could see this thing growing their earnings to $9.50, $10 a share. So still, in our view, very cheap with very well capitalized balance sheet.
Got it. All right, let's go to another of your past picks. Cisco Systems on the NASDAQ, sold at 58.06 by your company, right?
By our practice.
Your practice,
yes.
Sorry. And recommended initially at 46.65, again, July of last year. 63.17 is where we are now, 35% return, 37% total return. So a very good investment at the time and in the last number of months. What's going on at Cisco?
Well, Cisco has sort of transformed itself because they made a major acquisition in a company called Splunk. And Splunk has to do with cybersecurity and, more software-related type of stuff, and a lot more annual recurring revenue. In the beginning, Cisco is always this hardware play, right? So lower margins, manufacturing costs, and not a lot of recurring revenue. They've really switched up their model to where the business itself gets a lot more annual recurring revenue. So. Okay. Steady Eddie, they keep making really good acquisitions. They're very good at M&A, acquiring, integrating, cutting out costs, good dividend yield, great balance sheet, and good management team. Okay, so you sold, but I'm just wondering if you would tell people to hold on to it at this point. If you have a very long-term view, yes. It's not cheap anymore. When we bought it at 46, we thought it was cheap. By the time we sold it, we thought, okay, maybe it does have a little bit of upside, but pardon me, not enough margin of safety for us to, keep holding on, and we wanted to recycle the capital into something else. But, nothing wrong with the business per se. It was more of a valuation call rather than anything else. Got it. Okay. I'm interested in your next past pick, Magna International. Let's take a look at when you recommended it last summer, 57.63, and now dropped 53.60, 7% down in return, 4% down in total return. And I'm wondering how much of the drop we're seeing, well, we can take a look at when it hit, has to do with the trade war, has to do with the tariffs and the integration of the system in North America. I think most of it. Okay. Magna reported really good numbers most recently. They've got a great balance sheet. They've got an amazing footprint. They're a global manufacturing powerhouse. They keep winning awards from, multiple manufacturers. What I like about the auto parts maker business is that unlike owning an auto manufacturer, you don't have to worry if GM is going to do better than Ford or Toyota. You got to worry that the overall auto business is going to do well because the parts manufacturers need to constantly supply parts to whoever is getting the sales. And so from that perspective, we like that business. It pays a really nice dividend. Like I said, it is a leader. There's pretty much, I would say, 4 or 5 major global auto parts manufacturers on the planet, Magna being one of them.
Yeah, it looks like a lot of them took that little bounce when Donald Trump got elected, thinking this is going to be a great time for business, and then the trickle-down effect sort of after that. Okay, we do have to take a quick break. We're going to be back with Mike in a moment, portfolio manager at Propellus Wealth Partners. We're back in a moment. Welcome back to Market Call. We want to go straight to the phone line to get your questions in today. Yuri is calling on the line. He's calling from Toronto with a question for Mike. Yuri, what's your question?
Hello, thank you for taking my question. It's about JPMorgan.
Okay, let's talk about JPMorgan.
Sure. Thanks, Yuri, for the call. Listen, JPMorgan's a wonderful bank. Jamie Dimon is a wonderful leader, very smart. It's conservatively run. But this is a premium bank, and you are really paying a premium to be a shareholder here. So this is not something that we would buy at this valuation. However, if it corrected a lot more, definitely one of the go-to names that I think I would like to own in the portfolio if I was looking for more U.S. banking exposure. But again, at this valuation, it's not cheap enough for us.
Got it. Let's go back to the phone lines. Eddie's on the line. He's calling from Montreal today. Hi, Eddie.
Yes, my question is regarding Rogers Communications.
Okay.
I see that Rogers now has dropped 32% in the last 12 months, and yet the analysts still continue to rate it as a buy with a target of between $60 and $64. Yet these are the Rogers Class B shares, which are non-voting. I'm just wondering what your opinion is on this investment and why the analysts get this wrong this year.
Yeah.
Thanks,
People are
Eddie, for the
split on
question.
telecoms, I think, at this point, right?
Yeah. So we like Rogers. Full disclosure, we own Rogers. We bought in a little bit higher than where it is today.
Okay.
You know, I think that this was a culmination of a lot of different factors, Eddie. I don't think there's anything necessarily wrong with the business, and I think that the valuation is cheap. However, what every shareholder needs to know is, like my comment on CN Rail, this is a very capital-intensive business where technology does change every once in a while, and so there's a lot of CapEx that needs to go into it. I think the other thing that the market participants didn't really like or didn't understand or are unsure of is the whole MLSE acquisition. And that was right after the Shaw deal, which put a lot of debt onto the company, and they were doing a really good job of paying down the debt, increasing the synergies, increasing the earnings, and now all of a sudden MLSE, they're buying 37.5% stake.
I was going to say, so
billions.
investors just thought it was a big buy and not necessarily a great time to buy?
Yeah, and then you've got the whole uncertainty with the tariffs and the U.S. dollar and the Canadian dollar going down, et cetera. But I think over time, this is going to be a great hold. We own it. We like it. We're not selling. We're holding. And in the meantime, you get a nice dividend.
Got it. Okay, let's go back to the phones. Paul's on the line, calling from Mississauga, Ontario today. Hi, Paul.
Thanks for taking my call. The question is on BNS. I'm looking at it as a turnaround story. I'm not sure if I can trust the management to pull it off, but it seems very compelling, and I can't wait it because it's over 6% in a dividend. Would you go into that story now, or would you prefer another investment?
All right. All the banks had their fourth quarter out fairly
Yes.
recently.
Yes. Thanks for the call, Paul. So full disclosure, we do own Scotia Bank.
Okay.
We did sell about 40 to 50% of our position at $79, $80 when it hit that price point. I forget when it was,
Okay.
because we thought it ran a little too much, but we thought, hey, maybe it could keep going, so we'll keep some. Now that it's back down below 70, we may think of repurchasing what we sold and increasing our position again. Paul is absolutely correct. The dividend yield is very appealing. I'm just not sure that the correction is over yet, based on my comment before on Goeasy with the whole credit cycle. So I think maybe we want to wait a little bit longer to see if we can get in a little cheaper. Having said that, Paul, if you have a very long-term view and you're looking for that dividend and you're not worried about price fluctuations, I think this is a reasonable entry point.
Are you concerned at all about Scotiabank putting enough aside for credit loss?
No, they've put a lot aside. They've actually been managing their balance sheet really well. I think Mr. Thompson has been doing quite a decent job at Scotiabank. I think when he came in, given that he was a complete outsider to the banking world, heads were turning because that was not par for the course in the banking industry, right? But I think he's a savvy business person. I think he's thinking about things outside of the box. They've been paring back a lot of their international divisions, repatriating capital. I'm still not sure about that 15% acquisition of KeyCorp in the U.S. and where the overall strategy lies with that, but I'm sure that the picture will become clearer as the months and quarters go by.
Got it. All right, let's go back to the phone lines. Anne's on the line calling from Scarborough, Ontario. Hi, Anne.
Oh, hello. Michael, do you think there will be a substantial backlash from Canadians that will affect the price of Amazon shares? Thank you.
So there's backlash, but I would imagine we're small potatoes compared to the rest of the world.
Yeah. Thanks for the question, Anne. So I would say to callers and anybody who's listening that backlashing on Amazon may not be the right way to do it if you're a proud Canadian, because there's a lot of hardworking Canadians that built their business on Amazon.
Sure.
So if you're no longer buying from them, you're actually potentially hurting fellow Canadians that depend on Amazon to sell their business and make money.
Yep, good point.
So I don't know if that answers the question, but I think we're small potatoes in the grand scheme of things for Amazon anyway, so maybe it makes a small dent, but I don't think it really hurts the overall business.
So if you do own it, you would hold it?
We don't own it. We've been looking for the opportunity to buy it. I think it's still not cheap enough, but if it pulled back maybe another 10, 15%, I'd probably take a stab at it with a very, very long-term viewpoint.
Got it. Okay, we are going to take a quick break. Mike Vinokur joins us in-house. He will take more of your questions when we return. Back in a moment. Thanks for joining us on Market Call. Let's go right back to the phone calls. Eric's on the line, and he's holding on to talk to Mike, and Eric's calling from Sudbury, Ontario. Hi, Eric.
Good day. Thanks for taking my call. My question is around Brookfield, BN, and BAM. They both come down significantly over the last week, which was a bit of a surprise to me that they came down as far as they did. Just wondering if he could explain or shed some light on that, and do you see either one of those recovering better? What's your preference, in other words? Would one recover better than the other? Because I know they're great companies, they'll recover.
Corporation and asset management. Yeah.
Thanks, Eric, for the call. We love Brookfield. We think Brookfield has wonderful management, and Brookfield created all these what I call baby Brookfields, right? You've got 4 or 5 different publicly traded entities. We just think that it ran up a little bit too much too fast, and we're not surprised by the pullback. If you look at every publicly traded private equity firm, whether it's KKR, Apollo, Blackstone, Onyx, Brookfield, they've all pulled back quite a bit. And I think that part of the issue is going to be liquidity. If liquidity tightens up, these private equity guys will not be able to easily sell their projects. And if they can't get that gain on sale earnings going, their GAAP earnings are going to start to suffer. Now, that doesn't necessarily mean that over the long term they don't do well, but it means that in the near term, cash flow, profitability, liquidity, maybe a lot lower than the market expected. Brookfield Asset Management, a bit of a different beast. They have the asset management income stream. But again, if you look at the projected earnings of that income stream, I mean, it's trading very richly to what we think is of value and to many other asset managers out there. So I would not be a buyer at these levels.
Got it. Okay, let's go back to the phone lines. William on the line calling us from Victoria, BC. Hi, William.
Hi, how are you today? I think you touched on this a little bit. I'm inquiring about KKR Corp. Or Inc. I fortunately bought it some time ago, have had a really good ride with it, sold a partial position, and since then it's sort of acted like a SpaceX rocket ship and gone down dramatically. Should I be buying my position back? Thanks.
I like the comparison there.
Thanks for the call, William. So full disclosure, we also held KKR, and we also sold it some time ago, unfortunately, and it went up without us, but now it's coming back down to almost where we sold it. Love the company, love their AUM growth and all of the different credit funds that they manage. I am looking at it again. Not ready to buy. I think the valuation, in my mind, needs to come down a little bit more to get me towards my margin of safety, because this one does not pay a big dividend.
Okay.
So all you're going to be waiting for here is capital appreciation whenever it comes.
Got it. All right, let's go back to the phone lines. And Chris is calling from Regina with his question today. Hi, Chris.
Hi there. I was wondering about Cineplex. I'm liking the setup of it and thinking of buying. Just wanted to hear your opinion.
Cineplex has been a puzzling one in the sense that, they've got what they've got and people are still going to the movie theaters, but you kind of never know when it's going to wane.
Yeah. Chris, thanks for the call. A storied company for Canada, of course, but not our cup of tea. Cineplex is one of those companies where they don't own the actual real estate. They have, to my knowledge, very long-term leases on their real estate. But the leasehold improvements that they need to make, they're the ones spending the capital.
Okay.
So if you go and you build out a movie theater, and then the attendance is just not there, you're losing money. And it's not like you can easily close up shop because a lot of the theaters are sort of custom made for the location, right? This is a very, very capital-intensive type of business, and you're not even in control necessarily of your own destiny. And what I mean by that is, if the box office movies aren't that great
this year, yes,
or they don't attract the viewership, what are you to do? I like to go to the movies once in a while, but I will admit that my wife and I a lot of times stream in the pleasure and comfort of our own home on our big screen TV. So I'm not sure about being an equity investor in Cineplex.
Yeah, and I think a lot of people are split on going and not going, so everybody has a preference now. Okay, let's get one more caller in. Jack is calling from Scarborough today. Hi, Jack.
Hi, can I get your thoughts on National Bank and what a good valuation would be to enter? Thank you.
Thanks for the call. We like National Bank in general. Think it's a great run bank. Full disclosure, our dealer custodies with National Bank. So we think they have a great platform. We think they have a good banking franchise. I think that my concern at this point would be that if the economy is heading for a contractionary period, whether it's because of tariffs or for whatever the reason is, National Bank doesn't have the geographic exposure that the other 5 banks do. And they do have a very small footprint internationally and in the US, but it's very small compared to, let's say, TD or Royal or Scotia. So and they are mainly Quebec-based. So if the economy in Quebec starts to sour, and if their other business units can't pick up the load, then you're going to see a much bigger contraction in their earnings. Having said that, if you do see a much bigger this company has done an extremely good job of growing over the last 10 years. So I would not bet against the management. It's simply more of a macro call view.
Got it. All right. We do have to end phone calls. At this point, we're out of time for that, but don't go away. Our guest is going to share top picks. That's coming up. Welcome back. Thanks for joining us. We have top picks at this point, so let's get right to that. Mike is in-house, and his top pick for moving forward is Corebridge Financial, CRBG, on the New York Stock Exchange. Tell me about Corebridge and why you like them.
So Corebridge is a spin-off from AIG. So it's a life insurance company. They do life insurance and retirement products. Very well run by management. In our view, it's extremely inexpensive. Great margin of safety. At this price, it's trading at, 6 times forward earnings. We think earnings can grow very quickly. They've got a very large RBC, which is the regulatory base of capital required by the regulator. It's well above the buffers required. And so it pays a very nice dividend. And they've been serial acquirers of their stock, which at this price is very accretive.
Okay, Corebridge Financial there. Let's move to your next pick, which is an interesting one because it's Parkland, which is PKI on the TSX. And they are now looking to perhaps look at buyers. It's something that's part of their strategic review that was forced on them. Yeah, so one of the big shareholders, I think they own 19.9%, has not been happy with management's strategy and is agitating for change. They had a standstill agreement. That standstill agreement by the courts was rendered to be, I guess, null and void or over, if you will, and now they're basically pushing management to look at enhancing the value. And so the company even came out the other day, reported earnings, and said, we're not opposed to a full sale of the company or a sale of a few of the portions of the company. So they've hired investment bankers to see what they can unearth. These are world-class assets. Company is very cheap. I don't know why it's even trading where it's trading, other than the fact that, refinery margins have been coming in and, just general malaise in the economy. But this specific business, we think, is very undervalued, and they will accrete the value some way, somehow. Did they have a fourth quarter loss? Is that what sort of sparked Simpson Oil to say we need to sort of see some more, we need some action? Well, it may have been a gap loss, but EBITDA is very high with this company, and they guided for 2025 an EBITDA number of $2 billion on a $6.3 billion market cap. Like, this is not an expensive multiple for these kinds of assets. But they have debt. And but they have a lot of free cash flow, and management put out a plan that says over the next 4 to 5 years they plan to buy back $2.5 billion worth of stock, which is almost half the company at this price. So one way or the other, I think that there's a lot of value here that could be unearthed. Got it. Okay, let's go to your last pick. Moving forward, Secure Waste Infrastructure, SES, on the TSX. Tell me about them. What do they do, first of all? So they're involved in waste remediation, metals recycling, things of that nature. Their business is very sort of recurring revenue business. They've really transformed the company over the last 10 years. Today, about 80% of their EBITDA is recurring cash flow. The cash flow conversion rate to free cash flow is extremely high at somewhere in the 50% range. They've been growing by acquisition and organically, but what's really impressive is that the management has really been allocating capital to buybacks and has bought back a huge amount of shares in the last couple of years. And I believe I saw just the other day that the chairman bought a very big position in the company, added to his shares. A nice dividend in a industry that is not too cyclical, that doesn't get too hurt by tariffs, and in a valuation that's, very, very inexpensive in our view. Okay. I do want to circle back to where we started today because of the volatility and all of the drop in the red that investors are seeing and people are worried. I'm just wondering if you can give some overall advice to Canadian investors who, are watching their numbers drop and kind of don't know whether to take action or just stay put. Okay. Number one, the last 2 years have been very good, generally speaking. Number two, we've only dropped from the peak about 6, 7, 8%. This is not Armageddon yet.
This is a normal course correction. But as an investor, you need to know where your pain points are, you need to know what your objectives are, and you need to know what an appropriate asset mix is for you. Corrections are actually good. They give investors the opportunity to buy in at a reasonable price instead of having to chase up at the top. But we need to see if this correction becomes something much worse.
Okay, so keep your eye on it, and I guess if it dips a little bit lower and makes you uncomfortable, then you consider your options.
Exactly.
Mike, thanks for coming in. I appreciate your time.
My pleasure. Thank you.
That's all the time we have here on Market Call. Thanks for your time. We'll see you again on Monday.